Welcome. This is Drew Blazsik. I'm going to interview Brian McCall, who is a professor of law at University of Oklahoma College of Law, who authored The Church and the Usurers, The Unprofitable Lending for the Modern Economy. He holds advanced degrees in Yale, at the University of London, and the University of Pennsylvania, and has written extensively on law, ethics, and financial justice. Welcome, Brian. Thank you
Uh,
for joining me on this great conversation.
It's nice to meet you. It's good to be here.
So we're going to talk about usury here, and I've written about it before. I've talked about it before. Create a few videos. I read most of your book and I found it very interesting. There's a colleague of mine, Ben Brown. He used to work at a Catholic school called Lord's University, and we did at the Catholic conference. And I used a lot of your stuff in your book on our paper that we are presented. So I think the first thing we could talk about, how would you define usury?
That's a great question, and thank you. You're better than students. You read most of the book, so at least you're honest. Students usually say I read the whole book when they really didn't read very much. So, but it's a good question, and it's a difficult question to answer because once I dug into the history of this topic, I realized that there was a major shift in definitions and terminology that can really confuse the issue. And that's really a change of definition of the word usury and the word interest. And this is a mistake. You'll see a lot of people who write about the history. They'll go back and find an older text from Roman law or even older, and they'll say, oh, look, see what this says, but they will be using kind of these words in very different meaning. So with that in mind, in a modern context, using the way we speak, I would say usury is the charging of a profit on a loan which is made to someone for the purpose of consumption or the purpose of what I call kind of mere spending, as opposed to, in contrast to, the sharing of profits of a business venture when a party invests capital or invests money in that business venture, regardless of what it's called in our legal system. So even if in the legal system that investment of a business is called a loan with interest, that's not usury in the sense we're talking about it, but it's merely attempting to make a profit from lending someone to money who will simply spend it in a way that is not creating for that person a possibility of new value.
So would you say, is that defined as a comparison between a productive asset and a non-productive asset?
I think some people have talked about it in those terms, and I think that can be helpful, but you have to be careful because there may not be an asset involved, right? I might be spending the money to buy medical care for myself. So it's not so much an asset as I would say use of the advanced money. So what is the use being put to? It might be acquiring a productive asset, um, but it's not the asset itself. It's what is the intention of the parties in the transfer of the money to what is going to be done with it. In like banking finance, usually almost every loan agreement has a use of proceeds, right? This is what you're using the loan for. That's the heart of what we're looking at.
Well, so it gets a little complicated thing in modern day because back in
Yes.
the day, most people did not like to go into debt. Like it was looked
Yes.
down, and you would go into debt if you had to pay taxes when the king issued taxes, or you had an emergency, you needed food. So that would be considered usury back in the day if it
Yep.
was I need to consume food or pay taxes, correct?
Mhm. Yeah, or
Now what
I mean, anything kind of like that. I needed to pay my rent, or again, and you touched on something really, really important. There was a major shift in the 20th century, just in attitude that you're talking about, because even in the past, when there was no quote usury involved, because again, usury is demanding a profit on that transaction. There was nothing wrong with you need to pay your taxes. You're going to go to jail. I'm your friend. I say, hey, I'll lend you the money. Pay me back when you can. That's not usury. That's just a loan. But even that, there was a stigma attached to the idea that you had to borrow money was even if there's nothing immoral about it, was considered, you really an unfortunate circumstance, is not positive. And what happened in the 20th century when kind of usury was let out of the box and almost anything goes, is that stigma was removed. And it's almost now a stigma if you're not in debt in our economy.
Yeah, yeah, I was going to get into that.
Yeah.
Our economic system promotes debt, especially because things get the money gets devalued, which means
Yes.
it makes sense to go into debt to pay the interest before the
Yes.
price goes up sometimes.
Yes.
Um, so so okay, so we clarify that. Let's hit a couple modern aspects to it.
Hmm.
You get you purchase a car that
Hmm.
doesn't have to do with you're not doing it for work. So
Right.
hypothetically, you're getting a
Yep.
car for consuming.
Yep.
Is that usury?
Yes. Again, I distinguish it. You're running a transportation business. You're buying trucks to run your business. Different. You just buy your family truckster, right? That, if the lender is demanding a quote profit, that would fall within the definition of usury because of the use you're putting to it. Now, the next hard thing to get into is, okay, what is profit? Because as a lender, it was under this legal and moral doctrine, it was always considered just to ask for compensation equal to what you loaned. So including any ancillary costs. So again, I like simple examples, right? If you come to me back in 13th century when we have a monetary system is based on gold coins, right? And you say, could you lend me some money? I say, certainly. I'll lend you 100 ducats if you pay me back next year. But my ducats are in my castle in Florence and I have to hire an armed guard because there's a lot of bandits. That'll cost me, 5 florins. It was perfectly just for me to say, well, I'll lend you the 100 and you're going to reimburse my expenses to go get the money. And so the distinction is between reimbursing costs of lending the money, which is fair to ask for, and demanding a profit. The problem with your car loan and any modern loan is that our monetary system has got so many problems that maybe is a whole separate topic we can talk about. I think it's not even a monetary system. It fails to meet the definition of a monetary system because what is the role of money is to be a stable way to equate value from value across items and across time. So the best monetary system is always stable, just like the best ruler if or tape measure if you're going to measure a room is one that is consistent in size, right? Think about it, if every ruler every had a different size to it, it really wouldn't work as a ruler. You say, well, this is 12 inches. Well, I don't know what that means because this ruler, it's 27 inches, right? That's what's happened to our monetary system. Money has zero stability over time because it is constantly changing for reasons we get into. And therefore, distinguishing between when I say pay me back in our system is very, very difficult because just on our simple example, we know if I loaned you $100 in 1950, if you paid me back $100 today, there's been a loss of money, right? Because you could buy a lot more in 1950 than you could today. Not so much because goods and services have changed, but primarily because the yardstick of measuring value is completely unstable, manipulable, and changed. And it's interesting. A person I found really influential in my research, Bernard Dempsey, who was from Harvard Business School of Economics. He was a trained economist and a trained moral theologian. He made this point that the money system has been changed primarily for the purpose of disguising usury, making it really hard, right? My example from 1950 makes it easy, right? I know I'm making up a cost, but where's the line between getting paid back equivalent value and charging a profit when your ducats were the same thing year after year? It was easy to know, but now it's really, really difficult. And he said that was intentional because those who are profiting from the system essentially wanted to mask it by, having a monetary system that's unstable.
So that kind of jumps into the next aspect of it of our current economic system is that before the borrower wasn't guilty of the sin back then, would you say,
Right.
correct?
I
The
wouldn't even say,
lend
yeah, never. Even now, I wouldn't distinguish between then and now. The
now
borrower is and was the victim. Yeah.
now the lender is the one, but it's not an individual. It's a system that is doing the usury, right?
Well, I think it's both now. I mean, I think you can have individuals. So if you come to me I teach a contracts case to my students of the guy desperately needed money for medical care. They loan him like a few $1,000s, and they basically make him pay back like hundreds of thousands of dollars, an insane amount. Where even if we can't know where the line is of cost to profit, like that's beyond, there's no doubt. Like there was extortionist profit. That is individual usury, the people that did that. But it's both. There's people that I think are intending to do it, but then the whole system is permeated with it in harder cases. So car loans, home mortgages, I wrote a whole chapter on because it's the hardest because they are fairly tight, sort of in what we would call interest rates, and how much is that usury? Is it not? It's really hard. Is it just sort of making up for inflation? Now, my reaction is if there's actually no profit in it, banks wouldn't be doing it. um, but it's a harder case to make than the individual. So I think there are still individual people who can commit the moral fault of usury intentionally, but others just, it's the system, it's kind of in the system, and it's transcending their individual choice.
And so people know, so how our monetary system works, the way to create money in our system is through debt.
Yes.
So if they issue new debt, that's more money. So the encouragement of our monetary system or government, they want people to go into debt so we have more liquidity and more money in the system. So you would argue, and I would argue, that the system is built on usury, and we have to promote it in order to get our economic way. So I want to bring this up really quick.
Can I just pause there, because there's even a more important point. You're absolutely right. Our money, what is a dollar bill? I do that in my class. I say, take a dollar bill out of your wallet. What is that? And they kind of struggle. I'm saying it essentially represents a debt that's thin air. It came from nowhere. Worst case, I say, if you go to a bank and borrow money, where does it come from? They just make it up. They put an accounting entry in your bank account saying you now have this money, but it didn't exist before. They created it to make the debt. But what's worse about the system is it's not just that money's based on debt, right? Money can be based on different things, but it's used in a way to transfer real assets, not imaginary made up assets, right? Real assets from the victims of usury to the perpetrators. Because so here's what happens. The bank, this is how crazy it is. The bank doesn't have any money. Like if you came to me and said, can I borrow a hammer? And I say, I don't have a hammer. I'm going to give you an imaginary hammer and let you have that. You'd say, okay, you're nuts. But that's what banks can do. There's imaginary money that didn't exist but for them lending it to you. So they create it out of thin air, lend it to you. But then if you don't go out and work and earn money to pay it back, they can come and take your car or your house or your business, whatever it is. And so the way the system has worked, these boom and bust cycles that we've become so used to, are loans are made, a certain percentage of them out of thin air, certain percentage of them are not repaid with real money, and then those assets get taken by the perpetrator. And that's really the crux of what's wrong with it. Because the lender, a bank lender, can create money that didn't exist but for the loan. It's not real, but can take real world assets, things that actually have actual independent value, if you fail to honor the contract and walk away with those.
Okay. I love what you said there. So this is my favorite. I'm going to tell you, let me know what you think. This is my favorite definition of usury. And this is coming from the Fifth Lateran Council. Yeah. It says, for that is the real meaning of usury, when from its use, a thing which produces nothing is applied to the acquiring of gain and profit without any work, any expense, or any risk. Yes. So I want to play off that. Is there anything you want to add to that definition at all?
No, I think it's a great definition. And again, you have to, if you want to get into details, what's an expense, but there's some nuances, but I think it's a great definition.
So let's play off this really quick. Yeah. So now I think this is easy with any work. The banker who lends or creates money out of nothing isn't working, right? And when we're talking about people, well, they got to write up the contracts, but they're not laboring. They're not producing it. They're just sitting back and So right away, that's showing the banker isn't working. He shouldn't have a profit off that definition.
And first of all, anybody that's taken out a loan from a bank, even if they are hiring a lawyer to make up the contract, the bank is not bearing that cost. Right? They're going to charge you origination fees to cover that. So even if I think you're right, their argument's wrong, but even if you play it out, they're already made whole for that. So the interest rate has nothing to do with those costs. Yeah.
Yeah, I remember because we looked at a 15-year mortgage or a
Yeah.
30, and then there's always that cost that goes with all the people that are doing it. So any work. Now let's talk about expenses. Now there
Yeah.
may be expenses. We're talking about lights, but like you said, I think those costs up front is covering it. It's not the interest, right?
Yes, exactly.
Now here's the difficult one. And I love trying to explain it and think about it. Risk. And I think risk has to do with not just risk, but opportunity cost.
Hmm.
But I don't like when people use the term opportunity cost, how I do in my finance courses, because
Yeah.
they make it look like if I have $100, I'm sitting back. Well, I could make this, so I'm going to be lazy and lend it to you. And if you don't pay
Yeah.
me back, I'm going to take that asset from you. So, can
Right.
you speak about risk?
So first of all, I think risk and opportunity cost are two different things, but they are often, as you say, people equate them. First of all, as to risk, that's the one justification a lot of people will pull out. Well, I charge you interest because the risk you will not pay me back. And what those who wrote and thought about this for centuries said, the problem with that is you're charging the wrong person, right? So you're charging the person that pays back their loan with the modern usury or interest is there actually was the risk is theoretical, but in that case, there was no risk. They paid you back. So what you're really saying is, I want to charge people who are going to pay me back for the harm caused to me by people who won't. Right. So it's that's the problem with the argument. There is a risk people won't pay you back, but you're actually charging the people who honor their contract for the people who don't. And what's interesting about this, there was this is another whole story, but there was this institution I found, I'll get to opportunity cost in a minute, but called the Mons Pietatis, which came in about the 14th, 15th century. And these were charitable organizations because the church and people recognize there are some people who just don't have the money and do have immediate needs. So they were set up to try to drive the usurers out, and they got charitable donations, loaned money to people, and were only paid back their costs. And but what was interesting is here's what they did to make sure that that there were no false motives, that you weren't just like lending again in too risky situations. We would say the originator of the loan, the employee that said, okay, you're a good candidate to loan this money to, if they didn't pay back the loan, that employee was docked, was basically charged for it. So in other words, our system, remember the financial crisis, they talk about nobody has skin in the game. Essentially, they were saying, look, you should only be lending to people that it's A, legitimate need, and B, they really have a prospect to pay you back. Otherwise, you're just burdening with them something they can never do. If they can't, they should go somewhere else. They need to go to a charity that will just give them the money. And to show that you don't lend to someone who has no prospect of giving back, essentially you're going to be held responsible if you're just lending out money. And again, we have this sort of opposite system. It's even worse with securitization, that the people who decide to make the loans have zero consequence, so they don't really care about risk. I think it's a facade for wanting to make a profit. Now, opportunity costs. That actually is one that the jurists and the moral theologians who talked about usury struggled with for a couple centuries, because they did recognize a legitimate point. Once you concede, my simple example, you have some direct cost to making the loan. So I'm a merchant, I run my store, I have a shipping business, you're in desperate need. I say, look, I really want to help you, but I don't have any cash. But if I take it out of my business and lend it to you at no profit, you're just going to pay me back, I'm going to be hurt. I'm going to suffer a real loss because I'm withdrawing needed funds from my business. I'd like you to make up for that. And they kind of struggled with it. They eventually said, if that's really what's going on, okay, that sounds like a legitimate thing. But they realized that you need to be really careful with that because there's a lot of potential for mischief, right? Exactly. If you let it down the slippery slope, you go, well, I might have been able to make this, or I could invest this, but instead I loaned it to you, so I'm going to make a profit from you. And so eventually the church settled on things, restrictions saying, A, you have to really be in a business. You have to really show you took the capital out of it. You have to have an actual money you would have made from that you can show, like we would do now by modern methods. What's your historical performance? And Alexander the Third, I forget now, I'd have to check my book, he basically said, here's the best test. If the guy claiming that they missed this opportunity cost would, if the potential borrower hit the lottery. I mean, it's not his words, modern example, hit the lottery and said, hey, I don't need the loan anymore. Would they be disappointed? We'd like, darn, I wish I could have loaned it. Probably they were in this for making a profit. They weren't really giving up an opportunity. But if they went, much better, I'd rather this money be in my business. That's kind of a like rough test of what their motivation really was. But the church admitted this kind of opportunity cost thing is a very fine line where there's some legitimate use of it and some where it's just a pretext.
Now, what if someone comes up to you and says, what about small amounts of interest, not large?
Again, the principle going back all the way to the ancient world, and not Christian is Jewish sources, pagan, was literally charging any profit. That the matter of the difference of profit is a matter of degree, right? Like all wrongs. If I slap you once lightly, or I punch you in the gut, they're both wrong. One is more serious than the other, right? So the amount of profit being charged is all wrong, but there might be a small amount. It was a small offense, greater. But literally, even charging, some examples will say, a penny more is usury, be it a de minimis minor thing. So it's not so much the quantity. Where the quantities become important now is in our confused world, where we're like, we don't really know where the line is between reimbursing and profit. And therefore, again, we have to make moral decisions. And what the church came out 19th, early 20th century and said, look, if the amount of interest relative to the loan is pretty small, we don't know where the line is. The monetary system masks it. Don't be scrupulous about your conscience, right? If you're just saying, look, I think this is more, I'm trying to estimate a cost, 5-6% of the principal seems roughly to correlate to inflation, or don't worry, that's reasonable. But the greater that gets, the more likely you've crossed a line that we can't see anymore because of the opaqueness of the system. So quantity now is playing a different role in the thinking because of that.
And Vix Prevenit, Pope
Yes.
Benedict XIV, I mean, he clearly said at the beginning, it's not the amount of the interest or if it's a rich person or a poor person, because the Bible will quote poor people not to give interest, but that doesn't mean you can do that to a rich person. Just because it says you can't do it to a poor person, right?
Exactly. Again, now the culpability of a rich to a poor person may be different. Just like, again, if I assassinate the president or I murder a civilian, they're both murder, but they do have different consequences in gravity. But it's interesting. Ben Jonson actually once quipped that, usury is not just about the poor, but they had a real problem in England at his time, that essentially usury is the undoing of poorly educated gentlemen, that essentially it was a way of stealing money from actually wealthy people. And, he said that's just as harmful to the society as, from the poor, or, at least as harmful. So it's not really, that's really not, it's maybe a relative factor for an aggravating factor, we'd say in the law, but not to whether the thing itself is right or wrong.
Have you ever looked into the connection between usury and the declining populations of different aspects of Europe? E. Michael Jones' book, he kind of like,
he does.
He showed that. I found that fascinating, is that what happens is when debt goes up, they try to outsource jobs. It goes away. People don't have as many kids. And we are in the largest probably debt society ever, when I would probably argue. And our declining population is very catastrophic. And I think it's very damaging to the church as well.
Oh, definitely. Again, I would say, here's what I'd say, is I like to be careful about claims. I would say there is a clear correlation between the freeing of usury, allowing it essentially at will, and population decline. And it's a strong enough correlation, and there's enough circumstantial evidence to strongly suggest a causation. Right. Again, I'm not doing a lot of empirical research. I think it would take more to prove that claim, but I think the hypothesis that the correlation is equal to causation is strong enough in our society.
All right. Next thing I want to ask is, I believe, and this is what I was kind of thinking about, and I gave a presentation about this. What about intentions? Now, if you go off the Fifth Lateran Council, and if I read that definition, technically, and this is my opinion, I'm a big advocate of Bitcoin. And I flipped my opinion last year and a half.
Yep. So did I.
But if I buy Bitcoin for the mere intention for profit without any work, is that considered usury? Because just really quick, let me get
Mhm.
this thought out, is that if I take money out of productive assets that I was investing in that's good for society, good for the common good, and I invest in something that produces nothing for the intention of profit, what's your opinion? Is that usury?
So again, you'd have to show that somehow, because it's not so much from one use to another. So again, the church has never said if you take business capital from a line of business that's higher profit and put it in lower profit, there's something morally wrong about that. It may be imprudent, maybe it's a bad business decision, but that in and of itself, or vice versa, right? And so I think you'd have to first, to get into usury, show that buying or selling Bitcoin involves lending money, which it's not clear to me it does, right? Again, Bitcoin, I'm going to distinguish. I might lend you Bitcoin, and that would be a loan transaction that could involve usury. But simply owning Bitcoin, I don't think we don't have at the root a loan transaction. Now, why might you buy Bitcoin? Where I've changed my mind is a legitimate use of money. Again, there are two legitimate uses of money, going back to Aristotle: to use as a medium of exchange, to be able to buy and sell things, and to be a store of value. To say, I have nothing to buy right now, but I just want to keep that value safe, rather than buying something, an asset that can decline in value. And so I think a legitimate use, because particularly of our monetary system, that not only is unstable but opaque, right? We don't really know what inflation is because the numbers are all manipulated. That if we, it's kind of like, I buy Bitcoin, I would say buying it is equivalent to buying, hey, gold coins right now. Some people say it because, look, I don't have anything, I don't want to, I'm not trying necessarily to make a profit. I'm just trying to hold the value, because if I leave $1,000 in my bank account, I know it's going to lose value. It's not going to be a store of value. It's going to be a loss. This seems less likely than that. And so if you're buying it for that protectionist purpose, now it so happens the last multiple years, both of those things, gold and Bitcoin, have more than held their value. They're certainly outpacing, inflation. But I think the intention, if the intention is primarily protective like that, I don't see anything wrong with that when we live in a world where, we're secretly taxed every day by our government through inflation.
So what if the intention is to invest into Bitcoin to make a profit? And that's
Yeah.
what most young people I speak to, they go, this is a good investment, which I have to admit, I bought some Bitcoin
Yep.
that I had the same view, right? And
Yep.
I'm thinking if I'm using that, because the Fifth Iron Council clearly said any asset that produces nothing, and if I'm using it for the profit or the gain of it, not just, and I totally agree. If it's going to
Yep.
hold my money, gold could hold money.
Yep.
Um, but it doesn't do the common good, which a productive asset, for example, of invest in farmland does for
Hmm.
society, right?
Hmm. Yeah, and again, here's where you get into more sources where they talked about just price or just profit, and buying something and selling it for more than you bought it for. And again, in one of those, there's a great, like, book, mid 20th century, that talks about this. And they basically say, look, first case is easy. I buy something, I add value to it, I manufacture with it, and I sell it for more than I bought it for. Easy case, right? That you bought it, I bought some raw materials, I made a chair, I sold it for more than the raw materials. That's easy. But he says, what if you just happen to buy something and to hold on to it, and it goes up in value and you sell it for more? And what the moral theologian said is, look, if that's fine, because your intention was to buy it for a legitimate purpose, and if you just happen to get lucky, and even if you think that's a possibility, I'd like to do that, that there's nothing wrong with that, assuming there's no fraud, manipulation, you're doing anything like that. And that's what I think. The example I would analogize from to Bitcoin is like a home, right? A home is not a productive asset. It doesn't produce any new value. We primarily buy it. Again, we've been sort of sold a bill of goods because they want to push mortgages. I mean, most people, my grandparents' generation, nobody borrowed money to buy a home. They've transformed that. But most people think I'm buying a home to make a money and to make money. And I teach like a little finance course to some high school students in a local high school here, and I say, get out of that mindset, because it's dangerous. But it might happen. Like, you should buy a house to meet your housing needs, and buy a house based on, this is a good value to supply my needs. And if it turns out that when you need to go to sell it, or it's time to sell it, or you need to move, it's worth more, then great. That's happy. You have a risk it might be worth less, but I wouldn't be worried about it because you're just using the asset for an intended purpose and it might be more. I think it's prudently risky to go around doing that. Like, I'm going to buy a house in New York so I can then make some money out of it. Because it's just high risk, right? Given what can
Yes.
happen. So I think analogously, it's the same thing with Bitcoin. If you're saying, look, primarily it's a hedge against all this nonsense out there. I think I will actually do better than it. That's great. But I do agree with you. I think there's a point of scale where it becomes problematic, where it collectively, so we all individually do that, but collectively, so many people are buying Bitcoin because they're in fear of, and they want to protect their assets and do well there, that there is, as an economy, less going into production. And so I think on the problem with that one is when it gets to scale, it can really harm the macro economy by withdrawing assets from production. But that's where I want to be real careful. I don't think people who are individually doing what you said you're doing, what I've done myself, are committing a moral fault. The problem is the government is the one who should be reconciling this. So we got the concept of the common good is, what is government supposed to do? People are pursuing what's good for them, and that's fine. But the role of the government is to coordinate that. So in doing it, you're not destroying the society. So the government, in a properly functioning government, would say, look, it's fine to put your assets in safe places to protect them that might actually make even growth. But societally, we do need to put some constraints on that for the good of all of us. It was what economists talk about, a prisoner's dilemma, right? We all would be better off if we didn't, with everybody collectively, withdraw everything from the economy and put it in Bitcoin. But individually, we think, well, I don't want to get caught holding the bag, so I'm going to run to the Bitcoin and, because I'm protecting myself. That's the role of the government, is to solve the prisoner's dilemma, to say it's better for all of us together to have some reasonable limit on that. But we don't have a government that's going to do that because our government's part of the corrupt system. I don't know. Does
Wait,
that make
so
sense?
oh, I loved it. That's great. I want to define it a little more with one more
Sure.
thing. I'm gonna try to not convince, but try to say the borrower may be committing a sin, and then we'll get into some economic
Yeah.
stuff here.
Okay.
Uh, the definition. So someone brought this to me, and I agree with this. That if I'm pronouncing it right, mutuum is the loan of what you mentioned,
Yeah.
consumable goods, right? And
Yep.
that's what the church is always, the Council of Trent, when they talked about usury,
Yep.
they brought up that kind of loan. Now, what
Yes.
a friend of mine was saying, and I was looking this up, and I think it was Alfonso Segori was talking about it too, was that if the lender doesn't have the ability to take the good away from you, so let's say I bought a house, I don't pay it
Mhm.
off, and he can't take that asset, is that usury if he charges interest? If that makes sense. And I saw some Catholic writers was trying to separate that.
So again, a motuum was a Roman contract, which was formed by me taking a non taking a fungible good, so it could be money, primarily money, but oil, grain, give it to you and require you to give the same quantity back to me. And that, in Roman law, it had to be exact for exact. So, and that's the context in which usury could be layered on. Interesting side note: a lot of the authors, we always talk about money. It technically applies to other things that are fungible like that don't grow in value per se. So again, the example I give is, if you say, "Hey, can I borrow a bottle of Cabernet Sauvignon tonight?" And I say, "Yeah, if you give me back." Obviously not the same bottle because you want to drink it, but a bottle of the same type, year, everything. But if I were to say, yeah, I'll give you one, but you have to give me two tomorrow, that would be usury, right? So it all is rooted in that context.
Okay.
But what the point about taking the asset is different, because when you talk about the house, now we have a third contract, which is, we're lending money for money, and then there's a claim, a property right in a third piece of property. That aspect, the pledge of the property, actually doesn't affect whether it's usury or not per se.
Okay.
That is a different contract, where usury is just a different contract. Wrongs can be committed, but not usury in that guarantee of a repayment through the use of an asset.
That makes sense. And I think doesn't that take the risk away from the bank as well? When we talk
I,
about the definition of it, because if you
yep,
don't pay it, they get real assets off of
yep.
created money, which they never had in the first place, which drives me nuts.
Exactly. And that's what again, the church said about some of these charitable lending organizations. They would take something as what we call collateral, a pledge of something. And they said strictly what has to happen is if they can't pay it back and you take the asset, you strictly can only keep the value of the asset equal to what you're owed, and you have to give the rest back. And again, this still survives a bit in some of our laws on surplus, but it's only above the principal. So, and they actually said a loan like that protects against potential usury, because again, they said you can't. You can only lend against an asset that's likely to give you equal value. You can't include sort of over collateralization in the way banks do now.
Okay. All right. So I read this. Have you read anything about Belloc talking about usury?
Yeah.
He wrote this essay, and it was a pretty long
Yep.
essay, but he told a story. I'm gonna see your opinion on this,
Yeah.
where if someone wanted, he had the labor to go get ore to dig in the
Yep.
ground, the capital that was funded by someone. Now he gave two examples. He gave one where it was a interest on it. The guy failed in what he did, so the lender took, even though he failed, he took everything he had, and he said that's usury. And then the other example he gave was he lent the capital to the guy, and they were going to share in the profits.
Yep.
And he said it's not unjust to ask for 90, 10, 50, 50. It didn't matter the percentage because
Yes.
they both shared in the risk. The other scenario, there is no risk because the guy
Yep.
took the guy's house away.
It's a great example. I mean, Belloc, it's a wonderful essay. I quote from it in several things I've written. And here's the distinction. I make this distinction in chapter, maybe it's 7 of book. I forget now. It's been too long since I wrote it. But we sort of did a first division. There's consumer loans to consumers, consumer purposes, investments in business. And we sort of put this side, investments in business, focused on consumer. When we get to the other side, we have to make a further division. And so it's sometimes when you provide money or capital to a business, it's not involving usury. Again, there are ways to do that justly and unjustly that are different principles, but there are some that still, even that context, can be usury. And the distinction Belloc hits on is correct, is if I'm just talking about sharing profits that are in fact made, I can request some of those profits. Now, I think he was a little, Belloc is always a little simple. He doesn't, which I think is good because it makes them accessible. But there are ways I can be unjust. I mean, 99.1%, if
Yeah.
literally, you're putting in much, much more effort, might be an unfair allocation of profits. It's not usury. It's an unjust price for my investment. So there's injustice can happen there. But on the other example, which our system allows and what I call for reform, is anybody who invests in a business, it's fine to get priority among all investors. So if I loan it as what we call in modern finance, like a senior note, a loan, to say before anybody else, preferred stock, common stock, I get the first skim off profits. That's fair. That's a reasonable thing to negotiate. Where it becomes problematic is there's zero profit. The business turned no profit, but I essentially say I go in and get to take away money from profits that don't exist to make a profit, right?
Yes.
So that's the problem. So if
And
we're
then,
going to divide up the failed business to get back what I put in, that's fine. But when I go and ask, so I loan $1 million to a business with a certain interest rate, it fails. I certainly can have a claim to get my principal back because I claimed first claim on that. That's our deal. But when I try to also claim what we call interest profit on that when there was no profit, I think that's actually unjust. And that's what our legal system and bankruptcy do allow. So I think that is an area where there is usury in that context.
and he connected to World War One when
Yep.
banks are lending to both governments,
Yeah.
and then the country that loses the war has to repay that debt, and they have nothing, which is very.
Yep.
I think it's a really it
Yeah.
goes to the heart, not just banking, but central banking of how
Yeah.
corrupt it can be with that we see with continuous wars. Okay, let
Yeah.
me make this argument real quick about the borrower. Is that I believe when in finance that we should be considering my car may break down. I need to save. I need to save
Mhm.
money to buy that car.
Yes.
Um, or we can go back in the day. Why don't we save money, maybe live a little poor at first, and then I'll buy a house
Yep.
rather than going 30 years in debt.
Yep.
Now, it's a more of a system thing when we talk about usury because the banks are lending this out and creating it out of nothing.
Mhm.
So the what we want as individuals, we want immediacy
Yes.
and we want it before any work.
Yes.
And so I want the nicer car. What was crazy was the average car price went up in the last couple of years. It wasn't because the car prices skyrocketed. It's because people want more
Right.
without work. And
Yeah.
and I think that goes to the eternal thing is that when people want immediacy and they want it
Yep.
now, you're thinking about the now. You're not thinking
Yep.
about eternal things. You're not thinking about what is hard. You're not thinking
Yep.
about like children are hard. You're investing for eternity.
Yes.
Um, and I think the borrower can make that materialistic sin
Yes.
is getting into
Yes.
debt. If you want to speak about that.
So first of all, I want to be clear. I said the borrower is never guilty of the sin of usury.
Okay.
That
Yeah.
that's true, but they can be guilty of another sin. Absolutely right. And essentially one of those sins could be a sin against prudence, right? Which a lot of think of us do, like just get into debt that's going to destroy our lives. I mean, it's kind of like excessive gambling is a sin because you're throwing away your money and abandoning your responsibilities to your family, for example. So again, I think they be guilty of the sin, first of all, of imprudence, of taking on debt that they know they're not going to be able to pay or unlikely to and are going to harm their family and themselves. Secondly, as you said, a sin of consumerism, materialism, certainly there. So I think borrowers can, but it's a different sin. It's not the sin of usury. And the last thing I'd just like to follow up on what you said is this is another thing I think we've learned about the harmful effects of usury. Your car loan example, a better example is student loans. So if you go back to college, even in the 1970s, if you compare the cost of university college education from 1970 to today, it is an astronomical jump. I will posit that is not because the education has gotten better. In fact, I think it's gotten worse. What
I agree.
happened? Student loans. So when the government came in and said, we're going to make it easier for you to borrow lots of money, what happens is as the amount of money you can borrow through these government programs, what did the universities do? They raised their prices. They raised their prices, loans, and essentially all that happened is it became more expensive because of the immediacy. You don't need to plan out how to save money. You don't have to plan how to pay for college. We'll just give you this pot of money. And now the universities say, wow, you now have a pot of money. We'll take that. We're now charging 50, 75. I mean, the school I went to, when I went there for college, undergraduate, I think my parents paid $20,000 in the 1980s, 90s for a 4-year bachelor's degree. 1 year at that same school now is $75,000.
Wow.
It's the availability of student loans.
Yeah. Um, Yeah, I think that that's and just for people to understand is that since our dollar devalues all the time, prices go up, and then it incentivizes the people purchase
Yep.
now, and it hurts savers because
Yes.
you won't save because you don't know what's going to happen with prices. Back in the 1800s, if you knew that price was going to be stable, it
Yep.
might incentivize me for 5 years. I'm going to save, and I won't have debt. And I think the system is built, like
Yep.
Dempsey said, it was
Yep.
purposeful
Yep.
and it benefits the one who doesn't work, which is the banker in that
Yeah.
regard, because the money flows up top.
And again, on the practical level, I don't agree with everything he says. I don't agree with some of his moral principles, but Dave Ramsey, I think, has been a game changer for some people in getting them to realize, even within those constraints, you can significantly avoid debt to buy cars, to go to college by being, first of all, aware of the system and then techniques, buy a super cheap bad car for 6 months or a year while you, instead of paying car loans, you save the equivalent amount, then trade that in, work your way up, and maybe in 4 or 5 years you get the car you want. So again, I don't agree with everything the guy says, but I think on the practical level, on some of these techniques for avoiding the falling into these traps that are set up, I think he has some good advice.
And if you look at not just that, the government promotes that. They promote you get to claim on the interest, no
Yep.
taxes for the government.
Yep.
For bankruptcies, who are the first one? The secure bondholders, they're number
Yep.
one. The equity holders are last. So it's really a promotion of that in that regard.
Well,
Now,
and again, worse to that, the student loan industry, I think, is the most corrupt industry. That one, most people don't know this. That debt will stay with you virtually till the day you die. You can go through bankruptcy, and Congress amended the Bankruptcy Act to
I
say
remember that
your
happening.
student debt sticks with you. The second thing they did in 2005 is they passed the Bankruptcy Reform and Consumer Protection Act, which did the same thing to much credit card debt. Not all of it, but a lot of credit card debt. Now, this is one thing I teach my students when I teach reading statutes. So it's the first lesson that the title of a statute has nothing to do with what Congress is doing, because they labeled making credit card debt never dischargeable, always collectible by a bank, a consumer protection statute.
So, a monetary system. Can you give me some monetary systems that you would, if you were king of America, what monetary system? And just let you know, my favorite, what I've studied, is the Chicago Plan.
Mhm.
And Michael Kumhoff, I don't know if you ever listen to him. He's with
Yep.
the IMF now, the Bank of England.
Yes.
He does a lot of presentations on it. They did a
Yes.
paper in 2012, which was very good. But then you have C.H. Douglas, Social Credit, I believe it's called, and there's some other ones, or the gold standard.
Yep.
What's your thoughts?
So I think it's not a simple answer. So I do not want to be the king for the day, because this would be a really it's not just something like you literally just say do this, for two reasons. One, it's a deeper problem than the monetary system. It's the monetary, the finance, like it's layers on layers of problems, and therefore finding a way. First of all, it's finding the right thing, and there's legitimate debate, right? There was legitimate debate, I think, in this country in the turn of the 20th century between a gold and a silver standard. And I think there was no absolute right answer to that. I think they both had pluses and minuses. I tend to think gold was better, but I think there are multiple things. Should Bitcoin be it? Should that become the monetary system or currency or something like it? Again, I think there's not a single magic bullet. I think there's legitimate debate on different systems. The harder question is the transition. So even if we were to all agree, gold we think is, and none is perfect, right? Gold is better than what we have, because almost anything is, but it's not perfect. It was still manipulable, less than now. But even if we all agree it's the best we can do, getting from here to there presents enormous consequences, enormous unintended consequences, people who get caught in the transition. And so I think it would take more than king for a day, because it's something that's going to have to, would take lots and lots of changes, lots of thoughts about how to transition from it so that people are not caught in the transition.
And a lot of people point to, everyone talks about 71 when Nixon got off the gold standard, but that was not, the gold standard was actually taken away from Americans. I think it was 1933 or 34.
Well, it was a long process, right? It ended with Bretton Woods, but it really started with the founding of the Federal Reserve. Even you go back further, it started with fractional reserve banking, essentially, then the Federal Reserve, then what Franklin Roosevelt did, the most dictatorial act, confiscating gold, defaulting. And then it kind of, Nixon, I say, put the period at the end of the sentence. So even that transition, essentially, because the bankers knew it, they knew if they flipped like the switch, they would get hurt. They planned a more than century, I think, transition because they knew that. So likewise, I think any transition away from it is going to have to take a significant amount of time.
And part of the reason I like the Chicago Plan is because gold is beautiful. And I think if you have that as money and people hoard it, money should be, and I always joke around about this, ugly, where I just want to transfer. It should be signify energy that I know Brian McCall worked this long for, and I could transfer that energy to something else.
Yes.
And I think, and then the production of gold, because you need money to grow at the rate of production, population, and Chicago Plan. And with the Constitution, that Congress should have the authority over it, which they like to pass the buck to other people, so they're not responsible. I think if anyone wants to look it up, I love the Chicago Plan. I think Milton Friedman recommended it, I believe, for a certain point, but a lot of Fisher, the famous Fisher equation, and
I mean, look, I think it's a good plan, and I do tend to think it is a good idea. But I think that social credit. There are reasonable arguments you can have about alternatives. And again, anything can function as money, right? The Indians, some Indian tribes used, certain beads or things that don't have the same intrinsic qualities of gold, but it did work. Again, for the reason you say, gold has some attributes that I think make it particularly suited for this. But again, I do like the Chicago plan, but I don't think it's something we need to insist is the only answer. And I think because of the transition, a healthy debate that could become out more in the open among different perspectives on this would be a good thing.
And the social credit one is interesting because that actually caught on in Canada. And the bankers, I remember reading that story, how they put tons of money to really influence that Providence, I think it was, or a certain area that had that monetary
Yep.
system. And then after World War II, pretty much everything shut down of the
Yep.
debate. And now it's just our debt-based system after
Well,
that.
and again, I think it's either part of the transition or a system like that. The movement of monetary systems to a more local level or regional level would be good. And again, money always had dual. There was a local level, but it still had connections to the international system. So again, like the British pound is a good example, right? It had primarily local focus in its creation. But it was able to be used very easily. You could pay for goods other places. I think a system that has more diversity in it, as opposed to the forced legal tender of the dollar, essentially. And there's been some interesting experiments that even in this country on small scales of local communities, local manufacturing companies paying with some of this sort of credit thing that you can use to buy things in your local grocery store. You can pay the local doctor, sort of and that doesn't solve everything. You still need monetary systems that can go to the larger economy. But I think if we start thinking the other way around, because money always started locally, the 19th century, although there were already problems with the system, there were lots of diversity of currencies. The banknote system was, there were differences, there were problems with that. But I think in a whole, it was better than a manipulated system controlled centrally by the Federal Reserve.
I know time is running. Do you have
Sure.
time to talk about the different laws that were passed that cause Vegas for our financial systems?
I
Like,
mean, I can tell a little bit. I run through the history in the book, and essentially, what happened is it was a use of the federal preemption power. Here's the short story. So usury used to be like most police powers, regulated by the states, and each state, because we've been speaking at the moral level. I want to be clear about what's moral. It's a different question what the law should do, right? Because as St. Thomas said, the law can't outlaw or stop all injustices or all immoralities. There's political prudence that comes into what should be illegal on the human level. Doesn't make it right, which is the problem. We've equated if it's legal, it's right. But there was diversity of opinions, particularly, and I think it was a good thing, right? This is a hard question. Where are lines drawn? It was left up to the states, and there was every state had restrictions on usury, some different than others. Essentially, that was not good enough. The banks didn't like it because they wanted to lend nationally and have freedom everywhere. And so they used the preemption power under the Constitution to essentially say that, and they did it a little bit gradually, but eventually any bank can lend anywhere in the United States and comply with the lowest common denominator usury law. And so what did you have? A couple states, North Dakota, Delaware, said, hey, we can make some money out of this. Let's abolish our law. And you had a race to the bottom. I mean, why are most credit card companies, you'll say they're in North Dakota? Well, that's exactly why. They were one of the first to lower the bar. And so the preemption power is mostly created, I think, as a good principle. If states are a mess, they're not dealing with a problem, then the federal government can say, states, you're not fixing this. We need to fix it. There was no problem with the state law. They actually used it to undermine state law, take it over by federal law, and authorize the casino.
so how did like laws like the Commodity Futures Modernization Act of 2000 with Bill Clinton?
Yeah, I mean that we're going to get a whole other that and some of those other laws with Clinton, with the Dodd-Frank Act, others. What they did is a little more than usury. They got into another area, which is we were talking about a little bit before, encouraging mere speculation that has no connection to financing businesses, and allowing pure speculation that caused the 2007 financial crisis, where essentially you literally just bet on things. You don't employ that capital in producing anything. And again, that law, some other changes they made, the legalization of credit default swaps, all contributed to that, which is a little different from usury. It's a little bit what we were talking about before, just utter pure speculation. And again, gambling, when it's, you know, a game and you're just among friends playing penny poker within prudence, there's nothing inherently wrong as an entertainment pastime. But when you literally have an economy driven by gambling and credit default swaps, one of the things that the CFTC rules facilitated are a great example. So a lot of, I said to my students, like, sounds really complicated. It's actually not. This is what a credit default swap was. The equivalent of, if you owned a house and you bought insurance, right? Your house burns, you get the money. That's a reasonable transaction. But if everybody in your neighborhood could buy insurance on your house, that's a credit default swap. Because what would happen is, now your $100,000 house burns down. Now the people writing insurance, and that one loss of 100,000 turns into payments of millions of dollars to all these people who have no interest in your house. They are not affected by your house burning down, but they make money from this bad thing happening to you. That's essentially what was authorized, because what it was is, I can buy insurance. So you're General Motors, and I say, I'm going to buy insurance. If General Motors doesn't pay their debt back, and I don't even own any of it, I get a big payment. So I'm betting on the fact that they're not going to pay their debt, that's the red that will come up on the roulette wheel. They won't pay, and I'll make money even though I'm not affected by it. That is an example of, I think, and is it surprising that then those events happen when major institutions in the economy will stand to profit from the bad thing happening?
I tell my students, it's like other people buying insurance on me getting
Yes,
cancer.
exactly.
And they're going to get a big payout if I get sick. So they have an incentive for me to fail.
Make you sick, right?
and I would argue too, it's not exactly usury, but it's like the spirit of usury. It's that
Yep.
gambling. It's gaining money off of something you didn't work for or
exactly
have to do with.
I would say it's not technically usury, but it's in the same spirit as usury. Exactly.
Yeah.
Making a profit for nothing, for no reason, right? Out of thin air.
All right. Last thing, I'm going to bring this up.
Sure.
I've done a little bit of research, and the argument about central banks back in the day were that they're private. Central banks are private, and you had incentivized people for the king to go to war. And a lot of people argued about that. Look, there's an incentive. If they go to war and they beat someone, we will get paid interest. So what I did was I did some research, and there are some private central banks, 1800s, and there's some public central banks. And what I noticed was the private central banks became global. They had global interest in war and just taking out resources. The public central banks were more regional. A lot of their majority were regional. Yep. And then if you look at the biggest one of them all was the Bank of England, right? England. Yeah. And what's crazy, the empire collapsed. I think most people say the 50s, 60s, it started to diminish. And I looked it up. They became a private to a public central bank in 1947. Yep. And then I believe it was France in 1948. So my argument, and I'm going to see what your opinion is, that the Federal Reserve should be public, because then we can audit it. It should be part of government, ahead of Congress, and it would cause less wars. Let's say you.
So there are some problems with public or private central banks. There's less with public, much less. But they're not perfect. The Federal Reserve System is neither public nor private, and it's the worst of both worlds for the following reasons. One, it is, and I do this to my students. I say, is the Federal Reserve private or public? And then I'll pull out an aspect of it and say, well, there are these privately owned banks. There's, commercial bank, and they'll go, it's private. And then I'll say, okay, then these are appointed by the President of the United States. Oh, it's public. I say they enforce regulations on other. Oh, that sounds public. So it's essentially a private bank masquerading as a public bank, getting the benefits of a public bank. And so it's worse, right, than a purely private bank. I mean, here's the worst part of it. They are the public regulator of safety and soundness. They are regulating themselves. That they're all the central bank, the Federal Reserve banks are controlled by the people that do the work are controlled by, they are appointed by this commercial bankers, right? The president, yeah, he appoints some of the people, but they're essentially controlled by them, and then they regulate themselves. So it's essentially like, the you know the people selling you goods, deciding whether they're safe or not, which, whether they, selling hazardous goods, determining whether they're safe or not, which kind of goes on with the EPA and the FDA now, but that's another story. But essentially that's the problem. But they masquerade as we're a government entity, but they're not. So when they get an advantage to looking like a public entity, they can play that card. When they get an advantage to being private, they can play that side of it. So I think the Federal Reserve, I mean, Bank of England was a problem. The Federal Reserve is the worst of all worlds for that reason.
And then that's what happens. Congress says, we're going to audit you. And then they
Yep.
say, no, we're private.
We're private.
You can't audit us.
Exactly.
And then you're like, well, you don't have the power to. Hey, we got the power. We got the public power to do that.
Exactly.
And I agree. And I think, and people got to understand this. I'm a market economist, right? I believe in markets, but money isn't a good as in I'm selling it. This should be controlled by government, and it should be controlled by authority. I think St. Thomas brings it up. Have you ever read Father Fahey's book, Money Manipulators?
Yes, that's a great book.
He brings it up. Great book on it if people want to read it. But money should not be a market as selling it. It should be controlled by the government, and should be fair. But yeah.
And if you don't mind, actually, since you mentioned that book, so I ran a conference this past March where I gave an hour-long lecture. Well, the whole conference was on the writings of Father Fahey, and I gave an hour-long lecture on that book, essentially. So if you go over to locals.com to Catholic Family News, you become a supporter. All of the conferences, it's about 2 days of conferences are there, one of which is on this sort of point that we've been talking about, and draws heavily on the Money Manipulators book. So
let people know the book. He never copyrighted, so I believe it's all free. You can get the PDF version very easy.
You can.
And it's a great book. It's a great book on it.
But the point out of that, before we leave it, is absolutely right. Interestingly, one of the fundamental roles of the sovereign, of the government, throughout political theory, like what is a government supposed to do? One of the basic ones is to protect a stable money supply. Like one of the king's oaths in the Middle Ages was to standardize and protect the weights and measures, which meant the weights and measures of the gold coins, right? The fundamental role of government is to have a fair, again, the market to work. That's great, but for the market to work, you need to have a ruler that doesn't change shape, right? When you're measuring
in our
the
Constitution
market.
Too.
And in fact, why did our founding fathers give as one of the primary roles to Congress to coin and regulate money? And essentially what's happened is that's become totally outsourced, not the role of government. In fact, the government is complicit in destroying rather than stabilizing it. So one of the reasons I think modern governments are failing the definition of a government. Essentially, they're not doing what governments are supposed to do.
So you would promote if they did a act to make the Federal Reserve a public institution? You would recommend that?
I think it'd be better than we have now. But again, making it public, you'd have to put the right safeguards on it that it doesn't get corrupted. But it'd certainly be better than what we have now. Yes.
Okay. Yeah. Well, Brian, I really appreciate it. This I can go on for forever. There's a lot of other things I was thinking about, but I don't want to.
No, great conversation.
Yeah, I appreciate everything. If anyone is interested, here's Brian McCall's book, The Church and the Usurers. Like I said, I read most of it. And when I read these books, I typically go to certain chapters that interest me and I read it. That's how I do things. But yeah, Brian, I really appreciate your time. And God bless and have a great day.
You too. Thank you.